going to go a bit quiet from the perspective of scheduled macroeconomic and company news over the festive period. Although, do please keep an eye open for any firm that tries to slip out a profit warning when they think or hope that no one is looking. But as a result of this probable quiet period, I thought we'd just do a short video looking at what happened in 2018 and what issues any trends may raise for your portfolios in 2019 and beyond, to help you with the research you may already be doing as you get ready for the new calendar year. Now, I'm going to show 5 charts, and this is the first one. Here we can see the total return, which means including dividend or coupon reinvestment, from the main asset classes, shares, bonds, commodities, and a few subsets. In all honesty, it makes for pretty sorry reading and shows just how hard it was for investors to actually make money this year. None of the major asset classes as a whole, equities, bonds, commodities, generated positive total returns in local currency terms on a global basis. The pound's drop did boost the value of overseas holdings, but apart from select areas such as technology and the FANG stocks in particular, it was hard to find winners in 2018, which may in itself perhaps raise the issue of whether the 9-year-old bull market is still in rude health. Next up, we look at the major geographic options available to you when it comes to stock markets. Again, if 2018 represented a bull market, it was a pretty odd one, as no stock market beat cash in local currency total return terms. Emerging markets even suffered a second half bear market, falling by more than 20% from their highs. Only America's S&P 500 index was generating a positive total return in local currency terms as I first wrote the script, and it's got worse since then. At least the pound's weakness again helped those investors who had the foresight to diversify away from the UK, but even the US suffered a correction, defined as a 10% pullback from its peak in the second half. This impression of possible gathering caution, despite all of the optimism which characterised the start of the year regarding the Trump tax cuts and talk of a globally synchronised economic recovery, well, that's also reflected in our next chart, the third one, which looks at stock market sectors. Using the S&P Global 1200 indices as a benchmark, the best performing sectors were defensive in nature, healthcare and utilities. The worst were cyclicals, financials, materials. Now this may suggest that someone somewhere has got doubts over whether the global economy and the global financial markets plumbing are in such good health after all. Safety first therefore worked out relatively well in stock market terms, but for all of that, bonds did not provide as much capital protection as perhaps some investors would have been hoping in 2018. As we can see from the fourth graphic, fixed income proved pretty tricky to judge right. Of all the major options available to investors, either directly or more likely through actively or passively run funds, only German government bonds, or Bunds, offered a positive total return in local currency terms. Again, at least the pound's weakness helped boost the value of the overseas holdings, but a dash for Europe's ultimate haven asset hardly smacked of investor or fund manager confidence in the future. And so, on to our fifth and final chart. So yes, it was pretty tough sledding out there for most investors for most of this year, but it could have been so much worse. You could have put all of your eggs in the cryptocurrency basket at the start of the year. If any one area was characterised by euphoria back in January, then it was cryptocurrencies. And in return, all investors got was a boatload of volatility and pain. Unbeknown to all of us, it turned out that Bitcoin in the cryptocurrency universe had actually peaked in price just before Christmas 2017. Bitcoin began this year at $14,110 for a total value of $232 billion. It even rallied to north of $16,000, but that proved to be just one of a series of bear trap rallies. And as I sit here, Bitcoin trades at just under $3,300 for a loss on the year of 75%. Ouch. In fact, it's got that tough for crypto holders that the combined market value of the 2,037 cryptocurrencies listed on coinmarketcap.com is now just $104 billion, or less than half of the value of Bitcoin alone on January the 1st. Now this is not to poke fun at crypto fans. Investing is a serious business, losing money all the more. But it does go to show how piling into the latest hot thing that everyone's talking about in the pub or by the office water cooler in the most excited manner can be dangerous and even bad for your wealth. If an investment opportunity looks that obvious, there may be a chance that more than a few people, and especially the industry pros, have already got in before you. and that a lot of the good news is already baked into valuations. And you do always need to do your own research and think once, twice, 3 times before putting your capital at risk. And you should make sure that any investment you make fits with your overall investment strategy, target returns, time horizon, and appetite for risk. And by appetite for risk, I mean willingness and ability to withstand losses. Well, I think that puts the lid on 2018. In our next video, I'll look at what could be the most important themes and charts for 2019 and beyond. So thank you for watching, and I look forward to seeing you then.